November proved to be the strongest month of the year for global equities, with the MSCI World Index up 9.1%, with a US-led rally which saw developed equities outperforming emerging markets. Emerging markets, however, did still enjoy a positive month overall, up 6%. Although China struggled to gain momentum, even in the face of stimulus efforts, the Nasdaq Italian and Spanish stock markets broke into new year highs. In sterling terms, year-to-date, global equities have gained 12%, with North America leading the way, with it being the key regional performer at 16%, followed by Europe at 11%. Growth outperformed value in all regions apart from the UK, whilst mid and small cap outperformed large cap. Bond markets also enjoyed a month of positive returns, with the Bloomberg Global Aggregate Bond Index up 5.5%. Similar to their rally in global equities, the US led the way again, with the biggest monthly gain in aggregate bond indices since 1985. While corporate and high-yield bonds outperformed government and emerging market bonds, all still produced positive gains. It's a differing story, on the other hand, for commodities, which fell by 3.7%, nickel falling 8.2%. And this doesn't tell the whole story, however, with gold and silver seeing returns of 2.6% and 10.6% respectively. In currency markets, meanwhile, the dollar had a difficult month, falling 3.7% against sterling. Most developed economies across the globe saw a fall in consumer price index throughout November. This has been thanks to easing financial conditions in the wake of the bond market performance, alongside growing optimism that interest rates have peaked and recessionary fears are subsiding. Energy prices continue to fall, with crude oil declining 6% in November on top of a near 11% decrease in October. These price falls have contributed significantly to lower headline CPI figures, with US core CPI data reaching its lowest level since September 2021, and indeed US jobs data showing a rise in claims to its highest level since November further suggests no immediate action is required from the central bank in terms of interest rate hikes. Across Europe, a fall in inflation was apparent, with the euro area inflation at 2.4%, and as a result, markets are now pricing in no more interest rate hikes, while cuts are expected eventually in 2024. In what was an overall positive month for the US, Q3 earnings beat expectations, while European earnings fell below. Meanwhile, corporate buybacks have been higher than the seasonal average, also helping to support equity markets. Tougher months were felt across the board in Japan and China. In Japan, core CPI rose to 3.4% in November, leading to increasing expectations the central bank, the Bank of Japan, will take steps to normalise their interest rate policy. Despite shifting expectations that interest rates could rise, which has also helped trigger some yen appreciation, Japanese equities still remained resilient, with export-oriented stocks outperforming. November also saw Chinese authorities continue to bolster its property sector, with a focus on bridging a $446 billion funding gap. Measures announced during the month, including drafting a financing list for eligible property firms and planning substantial low-cost financing. With Christmas approaching, I'd like to take this chance to wish you all a very Merry Christmas and a Happy New Year. Of course, throughout next year, we'll continue to keep you informed with any economic changes. And if there are any concerns, as ever, or if you wish to review your financial plan, please don't hesitate to contact your advisor.